Every few years, it seems, a news report on a person who usually fits this description appears. You have a person that led a pretty ordinary life and worked in a job that is extremely typical, like a janitor or teacher. Eventually, after decades of labor and leading a quite ordinary existence, they inevitably pass away. Moreover, they make a startling finding as their loved ones are managing their estate. They find out that the person they thought was the textbook definition of an average person was actually hiding a significant secret from everyone. It turns out that their loved one who had died had been making a fortune in the stock market. Your typical Joe amassed often millions of dollars over the course of their life, not being a banker or financial analyst and earning only a fairly low salary. These kinds of stories are motivating because they show that no matter where you are in life and how far away possessing $1 million stock portfolio may seem, as long as you put in the work, you can always improve your financial status. It is something that is still doable. And while a lot of books, blogs, and YouTube videos discuss these people, many of them fail to emphasize one of the most crucial aspects that contribute to their ability to accumulate such rises through the stock market. Hey, welcome to Stock Market Mate. For today's video, we'll talk about why successful investors love dividend stocks. Before we get started, subscribe to the channel and hit that notification bell to help us beat the YouTube algorithm. If you're done with that, then let's get right into it. Ronald Reed is undoubtedly one of the most well-known individuals in the stories we just mentioned. Ronald, who died in 2014 at the age of 92, was remembered as a quiet, frugal individual who didn't seem to have much money. According to all accounts, he was a fairly ordinary man who enjoyed cutting wood in his spare time and driving second-hand cars. He was the first member of his family to complete high school, and he then began working as a gas station attendant for close to 25 years. He repaired cars before working until 1997 as a part-time janitor. Although originating from a low-income household, he had a reputation for having a strong work ethic and enjoyed reading books at his neighborhood library. When Ronald passed away, his loved ones were startled to learn that he had built a fortune in the stock market totaling more than $8 million throughout his lifetime. Ronald left his stepchildren and friends a $2 million bequest, according to his estate. He also left $1.2 million to the library he usually visited and $4.8 million to the neighborhood hospital. National news organizations reported Ronald's story, and today his legacy has been discussed in numerous books, blogs, and YouTube videos. People enjoy hearing this motivating tale because it demonstrates that anyone who is disciplined, economical, and eager to educate themselves on investment can achieve financial success in life. But one aspect of Ronald's narrative that is frequently ignored is how he was able to choose his investments. What specifically did Ronald invest in to build up such a sizable portfolio? Ronald wouldn't buy any speculative investments, claims his lawyer. In addition, he avoided investing in IT firms or other ventures for which he felt he had a firm grasp of the fundamentals. Dividend priority was the key to Ronald's successful investing. According to his lawyer, he declared that dividend payments were the utmost importance to Mr. Reed and that he would not invest in any stock that did not make regular dividend payments to shareholders. Although spending most of his life without a computer, Ronald was aware of the dividend snowball's impacts. Dividends made up over 84% of the S&P 500's total return between 1960 and 2021. You may see how much of a difference that would be in your total return if dividends were not reinvested. With a $10,000 investment in the S&P 500, you would finish up with $4.9 million if dividends were taken into account as opposed to just $0.8 million if they weren't. Additionally, dividends can ensure that your investments generate income even when the stock market is stagnant. This was the situation in the 1970s, a time when it was clear that the stock market had a protracted downturn. Stock prices didn't really increase much at this time, despite the long-term trend showing that the market will always rise in value. Really, the 1970s were a lost decade of growth. Dividends really accounted for 73% of the stock market's total returns over the course of the decade during this period. There was a time between the late 1960s and the early 1980s when most equities didn't experience significant share price rises, but dividends allowed millions of investors to generate regular profits. Although Ronald Reed's situation may seem singular, there are many other instances of people who prioritize dividends and build a substantial fortune. Louis David Zager, a New Yorker who resided in a rent-controlled apartment, left a final estate worth about $18 million. He reportedly earned so many dividend payments that in his later years, he became well known for going on opulent Saks Fifth Avenue shopping sprees and for traveling constantly. In a strange way, you might say he lived a prosperous life while being a complete mess at home, even though he was more educated than Ronald Reed and knew about the appeal of living off dividend. For more than 30 years, Kurt Dickerman, a homeless man, gathered bottles and cans for recycling. When he had enough money from recycling to cover the necessities, he would put it in the stock market after learning about it from books he read at this local library. Many were startled to discover that when he died at the age of 60, despite being homeless, having no formal education, and dependent on recycling for money, his portfolio was valued over $1.4 million. Despite the fact that the deck was stacked against him, even this man was able to amass fortune in the stock market. Someone who didn't even want to pay the money to live indoors, even though he could have if he wanted to, is a rare example of extreme frugalness. The fact is, millions of investors depend on dividends every day for their returns. The most well-liked investment options are index funds and mutual funds found in 401k plans. Both pay stockholders dividends. The media tends to glorify people who swiftly made millions of dollars by adopting a higher-risk style of investing, such as utilizing a lot of leverage, or people who made a lot of money by investing in one particular asset that experienced an exceptional degree of growth, or the day trader who made the ideal entry into an investment using technical analysis and then exited at the ideal moment. The problem with all of these instances, though, is that they're isolated incidents. Most people who gain a lot of money quickly in the stock market nearly invariably engage in speculation, or what we would call gambling. You'll also encounter those who assert that they have been in the market for a specific period of time, sometimes even decades, even though their claims are unfounded or they are unable to regularly replicate their performance. It's frequently very challenging to confirm both their claims and those who have done this. We already know about the well-known fund manager Peter Lynch. Over 13 years, he can produce returns that are on average 29.2% per year. We're not saying it's impossible to make excellent speculative investments or use a lot of leverage to invest and make millions, but the likelihood that someone watching this video would be able to accomplish something similar is statistically zero. On the other hand, we frequently observe that some of the best stock pickers in the world are those who buy and hold dividend-paying stocks and funds for extended periods of time. Even index fund investors can thank dividend reinvestment for their overall gains. Looking at SPY, an S&P 500 index fund, we can see that dividends account for a significant portion of its overall return over the long run. On the top, you can see your returns if dividends were reinvested into purchasing new shares of SPY. On the bottom, you can show your returns if dividends were not reinvested. The average annual return is increased by 1.1% when reinvesting. Although while a difference of 1.1 might not seem like much, it results in an extra return of 27,585.42 cents over the course of 27.62 years, which is money that we would gladly accept and are certain you would as well. Not too shabby for a $10,000 investment, right? We believe it is very evident, given what we've looked at, that some of the greatest investors of all time became wealthy by chasing dividend investments. Even Warren Buffett, the most successful investor in history, owns a sizable number of dividend-paying equities. This is really enlightening because it demonstrates that you can amass enormous money in the stock market without a college degree, a banking position, or even coming from a very wealthy family. We all have equal access to the knowledge required to amass staggering amounts of money over the course of our lives. We don't need the expensive equipment that's used by big banks. We don't require the costly machinery utilized by large banks. Everyone can achieve financial success in the market if the Ronalds, Lewises, and Kurts of the world can. So to sum up the things we've learned, the sooner you start investing, the better. If you haven't already, you'll be able to compound your money for even longer thanks to this. Unless you truly need the money or are already financially independent, always diversify your holdings to protect yourself, and always reinvest your returns. Well, that's about it for today's video. Let us know your thoughts in the comment section. If you found this video helpful, kindly click the like and subscribe button. Thank you for watching, and we'll see you at the next one. If you enjoyed this video, you're going to want to watch one of these two videos right here. Enjoy!